Let's move on to our ETF Spotlight. Mike Santoli with us, taking a look at the anatomy of a comeback. Mike, how does it look to you?
You know, Sarah, it looks okay for now, and actually the tone of this comeback is somewhat encouraging, at least to keep the stock market at these levels. We had a 6.5% decline from the very beginning of May down through very early June, and then we've had this comeback. So here was the downswing. This is from May 3rd to June 3rd. The middle line right here is the S&P 500. That's in white. The orange line is the S&P Low Volatility Index. Those are the defensive stocks. You see how they did fine. They held the market up, kept it from going deeper. S&P HB, that's the more aggressive stocks, the high beta stocks. They had a tough time of it. That's natural as the market goes down. That's the definition of high beta and low volatility. They did their job. Now look at it since that point. This is basically the last 6 days or so that we've had this comeback. And of course, we have the reverse is going to be the effect. We have finally, especially in the last 2 days, you've had the more aggressive stocks, the high beta stocks leading the way. And that's, I guess, to be expected. You had semiconductors, you had the transports yesterday that were doing their part. The question is, can the aggressive stuff, can the more cyclical ones carry the weight as Treasury yields rise, that maybe you're going to have to offset those defensive stocks pulling back a little bit? That's basically your fix right here. You see it's not as dramatic here on the comeback, but the S&P high beta stocks up 7%, and obviously you're having some underperformance in the defensive stuff right now, as the overall index, of course, guys, keeps bumping up against that 2,900 level that we once again just hit this morning.
I guess a related point might be that bond yields have found some sort of stabilization, which is why the defensives aren't working as well, Mike. But is it enough of a confirmation from the bond market to get a green light for stocks? Because all of May we were talking about the big risk factor in bonds as a warning sign for stocks.
Exactly. I mean, I think that it's still moving in the right direction. You're still seeing a lift in bond yields this morning. So I think there's room for yields to keep moving higher before it pinches anything. But I would point out, the 2-year note is at a high for June. It's at about 1.93% this morning. It bottomed below 1.8. At some point, the PPI this morning was basically on target, 2% core wholesale inflation. Are we going to start talking about maybe the market got too aggressive in pricing in Fed rate cuts, and how much of that is in the stock market? That's the toggle I think we're on right here.
Yeah, whether Jay Powell was right about that transitory comment.